Most people think debates about interest rates are just politics. They're not. They're really arguments about who gets relief when the system is under pressure and who quietly absorbs the cost when it is. This isn't about left versus right, it's about control over money. In the US, money decisions affect more than markets. They shape mortgage payments, credit card interest, retirement savings, job stability, the purchasing power of every paycheck. When rates move, it's not just numbers on a screen. It changes who benefits today and who pays later. Understanding this helps explain why certain conflicts keep repeating. Elected governments and central banks don't have the same incentives. Governments operate on election cycles. They prefer conditions that feel good now: easier borrowing, faster growth, manageable deficits, short-term economic relief. Central banks operate on system stability. Their role is to protect the value of money, prevent runaway inflation, maintain long-term confidence. When debt levels are low, this balance is manageable. When debt is high, the tension becomes unavoidable. Why this conflict is becoming more visible? The US economy now faces several realities at once: large and growing national debt, persistent budget deficits, an aging population, rising entitlement obligations. Low interest rates make this structure easier to carry. Higher rates reveal how fragile it is. At the same time, inflation makes low rates harder to justify. That's when pressure builds, not in secret meetings, but in public debate. If you find this kind of system-level explanation useful, consider subscribing to The Unseen Market. This channel focuses on how financial systems actually function, not headlines, hype, or predictions. The limits of independence. Central banks are often described as independent. In practice, that independence works best when inflation is stable, debt is manageable, markets trust the system. When those conditions fade, independence becomes harder to maintain. Pressure doesn't arrive all at once, it follows a pattern. Requests for flexibility, public criticism, market uncertainty, gradual policy compromise, not because anyone wants instability, but because the system resists sudden adjustment. When institutions disagree over money policy, the outcome rarely harms those with the most protection. Historically, the cost shows up elsewhere: in wages that lag prices, in savings that lose purchasing power, in fixed incomes that don't adjust fast enough. Inflation isn't always an accident, it's often a mechanism, one that spreads losses quietly without a direct vote. Some people rely entirely on promises of stability. Others watch incentives. They don't panic, but they diversify into productive assets, into income-generating businesses, into stores of value that aren't policy-dependent, not out of fear, but out of understanding how systems behave under stress. This isn't about predicting collapse, it's about recognizing patterns. When the institutions that manage money begin disagreeing publicly, it's usually a sign that trade-offs are becoming unavoidable. Understanding how those trade-offs work doesn't guarantee outcomes, but it does help you make more informed decisions. And in a complex system, clarity is often the most valuable asset of all.